Well, our top story of the day is Nvidia. The chip maker is looking to stage a comeback, snapping its three-day losing streak. And Nvidia's slide dented the tech rally that has powered stocks to fresh highs this year. But the last moves and the latest moves are showing the S&P 500 sensitivity to Nvidia's stock movements. At least that's what our next guest says. Joining us now, we've got Barry Bannister, who is the Stifel Chief Equity Strategist here. Barry, great to speak with you here this morning, and thanks for joining us ahead of the opening bell. Going to be another critical trading session, it seems, at least for Nvidia, and that could mean for the broader markets as well here. I mean, just how much weight does this one name continue to have overshadowing kind of the rest of the market machinations?
NVIDIA is like the Cisco of our day. If you think about it, it takes about one generation to forget about a bubble. And the average baby boomer was about 41 years old in 1999. They drove stocks up vertically. They loved Cisco. It became the most valuable company. We had extreme optimism, narrow markets, high valuation, day traders with strange names. We even had overzealous prosecutors in Washington. Back then, it was Ken Starr going after Bill Clinton. Now we've got these. So I'm just astounded by the way things are very similar to 25 years ago. And if you get more quantitative, even more so, NVIDIA is just the poster child for this bull market.
So then, Barry, what does that tell us about where we're headed from here? Here we are, we're not too far from those record highs. We're under a bit of pressure here this morning, but more so for the broader market. What does this then signal?
Well, the market's expensive. I mean, if you look at the way we calculate equity risk premium, the earnings yield above the risk-free yield on offer, it's at about 2.5. We think it should be about 3. So the S&P is a good 10% above where it should be. There are a lot of other ways to value the market and look at equity ownership as a percent of households' financial assets. These are at record highs. These are at enormous levels. So we're concerned about future returns being lowered by the high level of today. There's no better way to get a low long-term return than to overpay in the current day. So right now we're looking at higher than expected inflation and lower than expected economic growth in the back half. This is a moderate form of stagflation. We don't see any Fed rate cuts this year. And as a consequence, the market can pull back, and that's been our call.
What's the extent of the pullback, Barry?
Well, I wouldn't feel disappointed if it fell 10% to about 4,900. We've been saying 4,750. We know that May, October, not just quantitatively, historically, but in this current context, May, October is a pretty risky period. If you're going to be getting more bullish, maybe think about doing it in fourth quarter. But I would be cautious, have some protective puts here going into the summer and early fall.